Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Chicago wheat, Chicago corn, and Kansas City wheat. Chicago wheat. In late May, the recent market peaked at the January 2022 low at 739, turning lower and not really stopping until the dark blue highlighted neckline of the February to April reverse head and shoulders pattern, currently at 572. I spoke on this level 9 weeks ago when I said, and I quote, "This is what we are testing right now. Should this give way, then the next support is the December 2020 low at 566, and I suspect that we might just see a slowing down towards there as the congestion throughout mid-February to late April starts kicking in under 588 and goes on all the way down to at least 545. So watch out for potentially some slowing from now onwards." End of quote. We have since then seen this slowing down. Not a complete stop, but a very strong slowing down. The congestion from mid-February to late April impacted on the market's decline, and we have formed a small bear channel since late June, highlighted in bright red on my daily chart, and it's currently 525 to 567. 2 weeks ago I finessed this bear channel into a descending wedge pattern, but this week I have finessed it back into a shallowly descending bear channel. Additionally, I believe that one should not look at this bear channel in isolation. Instead, look at it as part of the V-top, becoming a V-top with an extension, formed since late June. Now, so what can we tell from such a pattern? Well, usually such V-top patterns with extensions are small, much like the size of the earlier small descending triangle, and usually pennants or bear flags. Not so in this case, but it does not take away from the idea to have such a larger pattern. Thus, I would look for the bear channel lines to show some of the immediate support and resistance, which I have seen throughout July. The pressures in such a pattern will tend to be for lower prices. And I can see immediately that yesterday the market pierced and closed below the September 2020 low at 540, and also a low of late July at the same level. Below, we now have the important 38.2% absolute Fibonacci line at 521. Personally, I personally would even start considering or looking at the 2016 to date uptrend, currently at 479, and even the 2005 to date uptrend, currently at 451. But these are not targets, not yet, but they're just thoughts for another day. Chicago corn. The extension to the lower trend line, currently at 466, of the July 2023 to January 2024 descending triangle, as well as the long moving average, currently at 447, capped the market throughout May, leading to a small double top pattern. Prices then headed lower, below all the moving averages in mid-June, accelerating the fall once past the hurdle of the November 2020 high of 439. Prices finally halted between the November 2020 low at 403 and the October 2020 low at 387, creating a teeny triple bottom, and recovering all the way up to the highs 4 weeks ago of the 50% absolute Fibonacci line at 425. In the process of pulling back up, the market made a small July-based ascending wedge pattern. Late 4 weeks ago, prices penetrated the lower trend line and soon after exited the pattern. The market easily reached the primary target of 404.5, but it took until Monday last week to drop down and reach the secondary hardest to reach target X at 391. Last week I added a thought, and that was to look at the mid-June today action as a possible descending triangle. There were arguments against this idea, but I did find it elegant at the time, and as I said last week, and I quote, "We seemingly run out of time and space at the end of next week," so that is this week, the end of this week, "so we would be able to give perhaps a better appraisal in my next commentary." End of quote. Well, my appraisal is that prices have exited out of the upper trend line of the descending triangle idea, highlighted in dark blue on my daily chart, but instead of heading higher, they've headed lower, down towards the flat lower trend line, currently at 390 even. Now this could mean that we have a false break higher that we saw, and the market actually means to turn lower. I can grant you that, but it also may mean that we have a shallower and smaller descending triangle from late July to date, with the upper trend line highlighted in red on my daily chart, currently at 400. On top of all that, we have the purple highlighted late May to date downtrend, currently at 411, entering the frame, with its adjacent reinforcement of the short medium moving average just above, currently at 414. What is certain is the flat congestion line at 390 and the dark blue lower trend line, currently at 389, are the base of all these, and more likely when rather than if, at the moment at least, these get punctured, we might see some significant moves lower. So caution. Kansas City wheat. During February through to April, we saw the development of a rectangle pattern based on the 551 to 590 area. Now please remember this area, especially the lower level at 551, as it become relevant again to the more recent action. Anyway, after the creation of the V-top in late May, prices rapidly descended down to the extension to the lower trend line, currently at 581, with the late November 2023 to end of March 2024 descending triangle, along with the important July 2021 low at 578 and the March 2021 low at 559, are back into that previously mentioned rectangle pattern area between 551 to 590. Since then, prices have moved sideways to a little lower, all the time making a new shallow bear channel, highlighted in bright red on my daily chart, currently 538 to 583. This pattern construction is not a duplicate, but a familiar one of the V-top with an extension we've seen elsewhere. And as I've said elsewhere, I believe one should not look at this extension in isolation. Instead, look at it as part of a derivation of the V-top. So what can we tell from such a pattern? Well, usually such patterns are small and are pennants or bear flags, but not so in this case. However, it does not take away that much from the case for it being such a larger pattern. Thus, I would look for the bright red bear channel to show the immediate support and resistance. The pressure in any such pattern would be for lower prices, and I can see immediately that prices yesterday punched down through and closed below the important 551 support, and that below being tested not very far from us actually at the moment, we have the important 38.2% absolute Fibonacci line of 533. However, personally, I would even start considering the unreconstructed December 1999 to date uptrend, yes, last century, currently at 496, and even perhaps the twin dangers of the 2003 to date uptrend, currently at 446, and the 2002 to date uptrend, currently at 438. I should stress these are not targets, not yet, just thoughts for another day. The only other feature I'd like to discuss is once again a potential. This time a potential for the possible bow tie formation we may recently have had of the short medium moving average, currently at 599, the medium moving average currently at 616, and a long moving average currently at 616. This again is not a possible but a potential, as I'm really not happy about the crossovers here, but I thought I should actually mention it. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpick and ADM Investor Service International Limited. And here comes the final important bit.